Now, welcome back. We take the next question on simulation analysis, and very important things that we should have is this part, this table, and this table here, as well as this other table here, this table here. Now we did the previous question, and we did explain everything which was necessary. So you'll be given the selling prices and their respective probabilities. Then you accumulate these probabilities, and then the ranges. We discussed how to establish these ranges. The same you do with the variable costs. Establish the cumulative probability and the ranges. The same with the other table there. So let's take the question from the start. Now you are told that Galana Limited is considering to introduce a new cheap plastic rulers into the market. This will involve investing in a new plant at a cost of shillings to 80 million. The plant is expected to have a useful life of 5 years, at the end of which salvage value will be nil. The firm's policy is to depreciate all its fixed assets on a straight line basis. Due to market uncertainties, the unit selling price, unit variable cost, and annual sales volume of the new plastic rulers have been estimated stochastically as follows. Now we have the unit selling price, value, shillings at 5, shillings 30, shillings 50. The respective probabilities have been given there. And then, so note when we start doing our solution, these unit selling prices, we will accumulate these prices and then we establish their ranges. They have been given also the unit variable cost, the value 15, 10, 25, probabilities 0.2, 0.5, 0.3. Again, we will accumulate these probabilities and then we establish their ranges. Then annual sales volume values 4 million units, 7 million units, and 9 million units, and their respective probabilities. Again, we will accumulate these probabilities, and then we establish their respective ranges. Additional information. The firm expects to incur fixed operating costs excluding depreciation of shillings that million each. Number 2, the company's cost of capital is 17%. Number 3, the company's tax rate is 3%. Required 1, the expected net present value of the new product. Number 2, simulate the net present value using the following random numbers. The random numbers have been given there. Then number 3, what is the probability of success of the above project? Number 4, what is the probability of failure of the above project? That's your question. So note the most important thing is how to accumulate these unit selling prices, and then we establish their range, accumulate unit variable costs, then get the ranges. You do the same to annual sales, then the random numbers are the ones that we are going to use. So the first thing that you can see there as far as our solution is concerned is that we have said the expected net present value will be given by expected cash inflows times present value annual factor. Then you look at the number of years and the percentage. Then you minus the initial capital outlay. Then the expected net present value of the new product will be the expected selling price. You just be taking the expected selling prices, you just be multiplying expected selling prices, you'll be taking that 5, that is these values times the probabilities plus summation of this, that 5 times 0.3 plus 30 times 0.4 plus 50 times 0.30, and that will give you the expected selling price. So the expected selling price is that 7.5 shillings. Expected variable costs, we take these are the unit variable costs, 15 times 0.2 plus 10 plus 0.5 plus 25 plus 0.3. So that gives us expected variable costs of shillings 15.5. Then lastly, expected units. The expected units, you are taking 4 times 0.1 plus 7 times 0.6 plus 9 times 0.3, and that gives you 7.3 million units. Now those figures are this part here, these figures are in millions. It's 4 million, 7 million, and 9 million. The next thing is the next working is DTS, that is depreciable tax shield. Depreciable tax shield is given by depreciation times the tax rate. Our depreciation in that case is cost of that asset minus salvage value divided by expected useful life. The cost of this item was 280 million. The salvage value was 0. Expected number of years is 5 years. So depreciation is 280 minus 0 divided by 5. And your answer, you multiply by tax rate of 30% to get depreciable tax issued, which is 16.8 million. Then the expected contribution. Contribution is given by selling price per unit minus the variable cost per unit, and we have calculated our expected selling price per unit, that's 7.5, and we less expected variable cost of 15.5, we get 22. So the expected contribution per unit is shillings 22. Our expected net present value will be given by the expected contribution, we minus the fixed cost, and then we less the depreciation. Therefore, expected cash flows. Now let's establish that. We take the expected total contribution, because we have 7.3 million units as the expected units. You'll be multiplying that by the contribution, the expected contribution, which we said is that 7.5 minus 15.5, which gave us 22. So the expected total contribution for these units is 160.6 million shillings. We less fixed annual fixed cost. We are told the annual fixed cost is 30 million. If you look at additional information number 1, you have been told that the firm expects to incur fixed operating costs excluding depreciation of shillings 30 million each year. So the that million is the fixed annual fixed cost of that million. Then you less that, you get profit before tax 130.6 million. Then we tax the 130.6 using tax rate of that percent. So that gives us tax of 39.18, and the profit after tax is 91.42 million. We earned DTS, the depreciable tax shield. We got DTS of 16.8. We got 16.8. There's our DTS. So we earned back the depreciable tax shield, and our expected cash inflow is 108.22 million. So we will use that figure to compute the expected net present value. Since the implication here is that this project is generating 108.22 million shillings each year, and the expected life is 5 years, this constitutes an annuity. These are annuities. So you can either use your tables to read the present value annuity factor, having in mind that the cost of capital is 17%, because point number 2, you are told the company's cost of capital is 17%. So if in your table you have 17%, then you can look at 17% and then year 5. That number which you get there, you multiply by 108.22. Then you minus the initial cost of 280 million, because we are told that was the initial capital outlay. You are told this will involve investing in a new plant at a cost of shillings 280 million. So that is the initial capital outlay. We less that 280 million. Alternatively, you can calculate the present value annuity factor using this formula: 1 minus into brackets 1 plus rate raised to -5, then you divide by rate of 0.17 or 17%. The answer you multiply by 108.22. The 108.22 is this one, and then you minus the initial capital outlay of 280 million, and that's our expected net present value is 66.23 million. So having that now in mind, we move now to the next part. I think question 1, they were asking us to calculate the expected net present value of the new product, and that is our expected net present value. Next is simulate the net present value using the following random numbers. The random numbers have been given there, and then we can now take up that selling price. I started by showing you the importance of that. So these selling prices, we need to accumulate these probabilities first, and then we establish the range. So accumulating those figures implies that for the selling price, probabilities, these are the selling prices as provided for. Probabilities as provided for, and then accumulate them. 0.3, then plus 0.4, you get 0.7. 0.7 plus 0.3, you get 1. Then range. Range is quite important. Now range, we say that these numbers are between 0 to 100. Therefore, what you do, you have the upper limit and the lower limit. Now what you can do here, you just take 30 minus 1, you get 29. So 29 is your upper limit. Then 70 minus 1, 69. Then 100 minus 1, 99. You have established your upper limits. To get the lower limit, you just be adding 1. So 29 plus 1 is 30. 69 plus 1 is 70. So you have your ranges there. So you are through with that first table. The next is for variable costs. The variable costs, we do the same. The unit variable costs are here. The values are here. The probabilities are here. So you'll be taking 0 to 19, then 20 to 49, then 50 to 99. The same thing that you have done. So the variable cost now, for the variable cost, the units are, the shillings are here, probabilities are here, cumulate that. I've said that cumulative 20, then 20 plus the 20 plus 50 is 70, 0.7 plus 0.3 is 1. Range, these numbers are from 0 to 100, so you minus 1, you get 19, you minus 1, you get 69, you minus 100 minus 1 is 99, and therefore you just be plussing 1. 19 plus 1 is 20, 69 plus 1 is 70, and you are through with that. And then the last table will be for annual sales volume. So you first accumulate these probabilities and then their respective ranges. And we have something like that. Units are there, 479. Probabilities, accumulate this. 0.10, 0.10 plus 0.60, 0.70, 0.70 plus 0.30 is 1. And then the range, this is 10. 10 minus 1 is 9. 70 minus 1 is 69. 100 minus 1 is 99. 9 plus 1 is 10. 69 plus 1 is 70. And you have our ranges there. The next thing now is simulation worksheet, which now we are going to use the random numbers as provided for. Now we are going to take 10 tests. Now observe now the first column for tests 1 up to 10. Now once you have done that, I want to establish 10 random numbers using the ones which have been provided. Now note what I'm going to do here. I go now to my random numbers. See what I will do here. Now I will take 8. I'll take 8. Then 63. Then 05. Then 15. Then 60. Then 55. Then 24, then 36, 16, and 85. Those are 10. Then I'll arrange those numbers downwards. Now, the way I've taken them. So those numbers here. So random numbers now: 80, 63, 5, 15, 60, 55, 24, 36, 16, and 85. Then selling price now. So what you do for using these numbers, these random numbers now, for selling price, you ask yourself 80 is in between what and what. Go to selling price, that table which you drew there. 80, where is 80? 80 is between 70 and 99. So the selling price will be 50. So you have 50, you put your selling price here will be 50. Next, go to random number 63. Go to random number 63 and you go to the selling price. So if you take the selling price, we've said 63, random number 63. 63 is between 30 and 69. So 30. The next number will be 30. So that is what you do with the rest. I take 5 for you. 5. You go to the selling price. Where is 5? 5 is between 0 and 29. So the selling price will be that 5. So you put your 35 here. So let me do the last one for you. You check 15, the random number 15, and then you go to that table for selling price. 15 is between 0 and 29. So selling price will be 35. So you put that 5 here. So you do the same with all the rest. So just be checking your random number, and then you go to that table for the selling price. You check where that number range is. Now, once you have done for the selling price now, we go now to the variable cost. We continue with the random numbers. Continue with the random numbers. We have taken the first 10 random numbers, and then now we take the next 10 random numbers and we put them here. Now let's just go back to our random numbers. So I underlined the first 10 random numbers which I have used. So what I do now is I'll take now the next 25, 83, 75, 03, 37, 35, 52, 99, 02, and 70. So you arrange those random numbers downwards. You arrange those numbers downwards here. So 25, 83, 75, 03, that's 7, 35, 52, 99, 02, and 70. So those are random numbers. Then variable cost now. Variable cost, you look at 25. You look at 25 lies between what and what. Now, this time now, you are not looking at the selling price table. You are dealing with the variable cost. So 25 is the first random number. 25 is between 20 and 69. So the variable cost will be 10. So you can see the variable cost here, you have 10. Next, you take variable cost 83. 83, go to the variable cost, this table here. So it's saying 83 is between 70 and 99. So that is 25. So that number here, 83, you're using 25. Random number 75, you just take 75. 75 is between 75 is between 70 and 99. So you take 25. So you are taking 25, the variable cost. So what you do the rest now? You do the same, and you have the variable cost. Then continue now with the other random numbers now for the other table, which is for units sold. So let's continue with the random numbers the same way, the ones now remaining. So you just take the ones remaining, which we have not underlined. So it will be 60, 51, 30, 53, 85, 25, 39, 48, 52, and 15. So you have arranged those numbers, those random numbers here downwards, and then you go to that table now. So you ask yourself, 60, how many units? 60. So we have 60 is between 10. You're looking at the random number range. 60 is between 10 and 69. So how many units? 7. So 7 will be here. You're looking at 60. 51. 51 is between 10 and 69. So you use 7. The rest you do the same. If it is 30, you look at random number 30. 30 is between 10 and 69. You use 7. all that way until you have all those units there. The next being, once you have done that, you have now to calculate the contribution, which is the earnings before depreciation and tax. And in this case, you'll be taking the selling price minus the variable cost. You multiply by the units sold to get the earnings before depreciation and tax, which is also known as the contribution. So you take selling price now is 50, that is test 1. 50 minus variable cost of 10, so that is 40 times units is sold, 7. 40 times 7 is 280. For test 2, the earnings before depreciation and tax, 30 is the selling price minus variable cost of 25, which is 5. 5 times 7 is 35. Next, 35 minus 25 is 10. 10 times 7 is 70. So you do the rest downwards. So here, to get these numbers, we are taking the selling price, which is here, minus the variable cost, because selling price minus variable cost gives us contribution. And then that contribution you multiply by the quantity, which is these figures here, to get earnings before depreciation and tax, or the contribution. And after that, you have to get the after-tax cash flows. To get the after-tax cash flows, what we will do is that you'll be taking these earnings before depreciation and tax, then we minus 30. 30, we were told from where we had started our question that additional information number 1, the firm expects to incur fixed operating costs excluding depreciation of shillings 30 million each year. So that's a fixed cost of 30 million each year that we are incurring, and therefore we should get less than. So to get after tax cash flows, we are saying you take 280, these earnings before depreciation and tax, then you less that fixed cost of 30, then you multiply by 1 minus tax. 1 minus tax, that is 1 minus that percent, which is 0.7. Then you plus DTS, the depreciable tax issued, which we got at 16.3. We got this one here, depreciable tax issued of 16.8. So once you do that, you get after tax cash flows, the after tax cash flows. So basically, to get this column, you'll be picking earnings before depreciation and tax. You minus 30. That was 30 is a fixed cost excluding depreciation. You less it throughout. Multiply by 1 minus t. In other words, you multiply by 0.7. Then you plus DTS. DTS is constant, 16.8. You can just check this explanation here. The after-tax cash flows here, how we are getting this column here. So we have after-tax cash flows here. And then after that, we need the present value of the cash inflows. These cash inflows there, what is their present value? So one thing, note that these cash flows are constant. These cash flows are constant. And we are saying the machine has 5 years expected life. So note here, what we have done here, we have calculated the present value annual factor at 17% for 5 years. And we got 3.199 using this formula here. 1 minus, into brackets, 1 minus cost of capital, 0.17 or 17% over the same R, then you minus -5 is raised to -5, and you are getting 3.199. 99. So that figure which you have gotten there, you'll be multiplying by the after-tax cash flows here. You multiply throughout this one, you multiply by 3.199, multiply by 3.199, all these figures, so as to get the present value of the cash inflows, the present value of the cash inflows. And that is how you obtain the present value of the cash inflows, this column here. Now, once you have gotten that, you less the initial capital outlay. Now, once you less the initial capital outlay, you get the net present value. And we are told that this machine cost shillings 280 million. This is the initial capital outlay for that machine. And therefore, once you get the present value of the cash inflows, you less 280 throughout. You less 280 here, you less 280, and you have this column here. Then you sum up all this to get total net present value. So our total net present value is 133. Our total net present value is 133. Our workings are here. Down here, you can just be checking those workings here. Now, the last part is what is the probability of success of the above project. If you want to know the probability of success of this project, you look at the present value cash inflows minus 280, or in other words, you look at the net present value, which are positive. Positive net present values divided by 10, the number of tests or the number of trials. So what is the probability of this project being successful? Which ones have a positive NPV? We have 1, 2, 3, 4, 5, 6, and 7. So there are 7 net present values which are positive. So the probability of this project being successful is 7 over 10, which is 0.7. The probability of the project being successful is 0.7. If the probability of this project being successful is 0.7, obviously, the probability of the failure is 1 minus 0.7, 0.3. In other words, you take the net present values which are negative divided by 10. 1, 2, 3. 10 is this number of trials here. The probability of that project failing or not being successful, you take the net present values which are negative divided by the number of trials. So that is it about simulation. That is all about simulation. I would like to mention something here. Important that in our previous simulation example, this same question and problem when we were uploading. So we uploaded 3 videos concerning this question for simulation. So they do not, the solution do not follow one another well. So it is the same question that we have arranged in an orderly manner so that when you are doing it, there is a flow of information. It does not confuse you. So is the same question for simulation that we did last video or last lesson, but some viewers complained that the solution is confusing, or the analysis was confusing because it was 3 different videos concerning the same question. So to address that issue, we have repeated the same question about simulation, and there is a good follow-up. You can make a follow-up concerning the question itself and the solution, how the solution has been done. So you still get the same question in your YouTube account, but it is divided into 3 videos, and those videos were confusing the viewers. So it is the same question that we have repeated so as to address that particular complaint by our esteemed viewers. Okay, I'll still take one more question concerning simulation, and then for this semester, that will be the end of simulation. Then we will take sensitivity analysis. You take sensitivity analysis. All right. So as far as simulation is concerned, to conclude this lesson, I have said that we should be able to understand the variables which will be provided for. In our case here, we have unit selling price, unit variable cost, and the annual sales volume. We will be required to cumulate these probabilities and establish the range. Simulate, or that is accumulate these unit variable costs and have established the range. You do the same with annual sales. Random numbers will be provided for. So those random numbers are the ones which you'll be using. I believe you have understood how I have used these random numbers. Concerning establishing the probability of success or failure is not a big problem, but where you should concentrate most is even though this part again is necessary, this is also a very important area for calculating the expected cash inflows. But this section here, try to understand these 3 tables which I have here, these probabilities and how we accumulate them, their ranges, because this range is the one which will help us to establish the selling prices now using the random numbers by asking yourself the random number is between which lower limit and which upper limit. Then variable costs, the same, accumulate those numbers and you establish the range. We establish the range because they help us to know the variable cost, because you'll be picking a certain random number and then you ask yourself it lies between what and what. And lastly, the unit is sold. We do the same. And then this is the simulation. This is the simulation worksheet. That is the simulation worksheet, which is there. Simulation worksheet, which is there. And then we have answered our question that way. So my name is Mr. William, Fatima Institute Center for CIFA Studies. In case you need assistance from us, we are based in Thika Town, and my numbers are just down there in the footnote 0727871093. If you are calling from outside the country, you start with +254 727871093. So that is enough for that simulation. I'll take one more simulation and then I'll take sensitivity analysis. Again today, if you are doing chapter 2, because you are moving now to chapter 2 after sensitivity analysis, we have uploaded a question about capital market line involving computation, so you can still get an analysis on capital market line in our YouTube Fatima Institute. So remember to subscribe to our YouTube. You like our videos, you make a comment, and in case you need any clarification or any assistance from us, my numbers are just as I have given down there. I'm also a publisher and an author. I've written numerous textbooks on finance, accounts, economics, among other areas to do with management. So again, if you need textbooks, you can still call that number for that matter. So have a blessed day till we meet again for the next lesson. Thank you for viewing.